Hello everyone and welcome to this video, Introduction to Financial Accounting. So let's talk about accounting functions. Accounting is essentially an information and measurement system that identifies, records, and communicates an organization's business activities. So identifying business activities means that we have to select relevant transactions and events. Recording business activities requires that we keep a chronological log of transactions and events measured in dollars. And communicating business activities includes preparing accounting reports such as financial statements, which we analyze and interpret. Record keeping or bookkeeping includes the recording of transactions and events and is just one part of accounting. Accounting also includes analysis and interpretation of information, and that is something that we are going to continually focus on as we move through the series of videos focusing on financial accounting. So now let's talk about some users of accounting information. We often hear that accounting is called the language of business, and that's because it communicates information to help people make better decisions. People using accounting information are divided into two basic groups. We have our external users and our internal users. And when we're talking about whether folks are external or internal, we're always looking at it from the perspective of the company. So external users are going to be those people that are outside of the organization. Those are going to be folks like stockholders, potential investors. That's people that are potentially looking to buy the stock. Creditors such as banks, lenders, government agencies, that could include the IRS, that could include the SEC. We're going to learn more about those folks as we go on as well. Suppliers, customers, these are all people outside of the organization. These are all external users. Internal users are people within the company who are going to use accounting information to make decisions on behalf of the company. Without question, the internal users that we think of most frequently are going to be the executive leaders. That's like our chief executive officer, our CEO, chief financial officer, chief operating officer. Those folks in the organization who have responsibility for making those big decisions. However, it can also include departmental managers, such as production managers, purchasing managers, HR managers, and others. Now, once in a while, I'll hear a question, well, owners, couldn't they be both internal and external users? And so I want to go ahead and address that. If it is a small company where the owner is actively working in the business and actively managing the business, then they would absolutely be an internal user. However, for the most part, when we are studying financial accounting, we are focusing on financial accounting from the perspective of large corporations, where the owners and the managers are completely separate. So the owners are the stockholders who are, maybe this could include investment firms, institutional traders who buy and sell the stock. It's not going to be, people who are actively involved in the managing of the company. So I hope that provides a little bit of clarity on that. So again, external users are people outside of the company. Internal users are people inside of the company. So let's talk real quick about data analytics. And this is something that again, we'll focus on more in some future videos, but this is something that we hear a lot about today. Okay, data analytics. This is about analyzing data to identify trends, relationships, and indicators that can help people make better decisions. It helps them better understand what's going on, rather than just having, having a file with, 65,000 numbers in there, just randomly combined. Data analytics allows us to actually take that data and do something with it. It allows people to work with it and understand what is going on. And that's really what's key with data analytics. It's about using data that's already there to better understand what's going on. That way you can understand what's happened in the past and better plan for the future. And data visualization is closely related. Data visualization focuses on presenting data in a visual format, such as charts or graphs, to support decision makers. Oftentimes, you will hear when people talk about data visualization, you'll hear the term storytelling. And that's what data visualization is really about. It's about presenting data in a visual format so that it tells a story and people can understand what's going on. That's people who may not necessarily be accounting or finance experts. And that's something that's important. It's an important skill for accounting and finance professionals to have, because we frequently have to communicate with people who may not necessarily feel as comfortable with numbers and data as we do, and they may not necessarily, be able to look at a bunch of data and necessarily understand what's going on the way that we do. So when you have these skills in data visualization, you're able to figure out how to present things in a way that's meaningful to your audience, in a way that people understand it and they can use what you're giving them to better inform their decisions. Okay. Now, let's talk about some important acronyms that you're going to hear in financial accounting. First and foremost is generally accepted accounting principles. And this is key. Throughout financial accounting, we will focus on generally accepted accounting principles. In fact, every facet of accounting that we study in financial accounting is going to center on generally accepted accounting principles. We are only going to learn the practices that adhere to generally accepted accounting principles. That is the standards and principles that all publicly traded companies must adhere to. Now, again, if we're talking about a very small, privately owned business, they may have some additional flexibility. But if we're talking about large, publicly owned corporations, they are legally required to follow GAAP. And so that is what we're going to focus on in financial accounting. Now, the Securities and Exchange Commission, or the SEC, this is the U.S. government agency with the regulatory authority over companies that have either equity or debt securities traded on a U.S. stock exchange, for example, the New York Stock Exchange or NASDAQ. So all companies that have publicly traded securities are under the jurisdiction of the SEC, and they must file certain reports with the SEC, including financial statements and financial reports. Those are filed quarterly with a very, very detailed and audited version of those filed annually. That's what we usually call the 10K. Again, we'll learn more about that as we progress through. But just so you kind of get a feel for who these groups are that we're talking about. All right. So the Financial Accounting Standards Board, FASB, we normally refer to that as FASB. The FASB is the group that was assigned the task of establishing generally accepted accounting principles. Now, it's interesting to note the FASB does not technically have regulatory authority. The SEC has regulatory authority. However, the SEC has assigned the responsibility for establishing GAAP to the FASB, meaning that any of the standards issued by the FASB are enforceable. And that is what companies who are required to report to the SEC absolutely must follow in order to meet regulatory compliance standards. All right. So now we're going to look at the elements within the conceptual framework of accounting. So we start at the top with our objectives. Objectives relate to the usefulness of the information, including usefulness in making investment and credit decisions, assessing future cash flows, and evaluating a company's financial position. Qualitative characteristics include relevance, reliability, comparability, and consistency. Elements refer to the financial reporting components, including assets, liabilities, and equity. Now, I know I'm going over a lot, but not to worry. We're going to look at each of these in more detail in just a moment. Okay. Assumptions are going to include the economic entity assumption, the going concern assumption, monetary unit assumption, and periodicity assumption. Principles include historical cost, revenue recognition, matching, and full disclosure. And our constraints are going to be the cost benefit, materiality, industry practice, and conservatism. Now, again, I know that I just went over a lot there. Not to worry, we are going to talk about all of these in detail. But the important things to remember are that the objectives are always key. And all of these other items, the qualitative characteristics, the elements, the assumptions, the principles, and constraints should all support our basic objectives. And again, our objective is always to report information to financial statement users that is going to be useful to them, that is going to help them to make better decisions, whatever their role and responsibility might be. All right, so let's talk about those qualitative characteristics. Okay, the first one is relevance. All right, so when we're reporting something, we want to be reporting relevant information, and that just basically means information that matters. Information that is going to be important and that should be considered in evaluating a specific report or making a specific decision. Okay, reliability. We want to report information that is reliable, and that means reasonably accurate. Now, as we're going to learn throughout our studies of accounting, believe it or not, accounting is not something that's going to be 100% accurate. Okay, there are lots and lots of estimates and professional judgment that are involved in producing accounting reports. But reliable means that they are reasonably accurate. And so it's very important that we report reliable information. Now let's talk about comparability and consistency, because sometimes these two get confused. Okay? Comparability means that we want our financial statements to be comparable to other companies in similar industries. Okay, and so this is why we follow generally accepted accounting principles, because if every company is following different rules, then investors aren't really going to be able to look at the financial statements of two companies and really compare them to make a decision. So we want to make sure that we're all following the same rules, so that if we want to compare, Walmart's financial statements to Target's financial statements, we can do that, and they're comparable. Now, consistency focuses on a singular company and their reporting practices. We need to follow the same accounting practices from one accounting period to the next to ensure that, similar to with comparability, but with consistency, we want to make sure that we can compare one year against another. So if I'm looking at a company's financial statements for this year, and I want to say, well, how are they doing this year compared to last year and the year before that? Consistency means that we can do that we can look at their financial statements for 2 years in a row, 3 years in a row, 5 years in a row, whatever the case may be, and the company is following the same standards and principles every year. So we are comparing apples to apples and not apples to oranges. All right. So those are our primary qualitative characteristics that we need to meet. Okay. So now let's talk about the basic elements. And what you see here on your screen is what we call the accounting equation. Assets equal liabilities plus equity. You will see this over and over and over again in your financial accounting studies. Sometimes you may also see it presented as total assets equals total liabilities plus total equity. It all means the same thing. And as we progress, we will learn about the individual elements within each of these categories. In fact, in one of the next video series, we're going to actually really do a deep dive into the accounting equation. But for now, we'll just kind of do a brief overview of these elements, okay? Assets are going to have three basic characteristics, okay? First, an asset is something that the company owns or has control over, okay? And it has to be something that is expected to yield future benefits. Okay? So it's an economic resource that we own or control, and it is going to provide benefits in the future. Those are the characteristics of an asset. Okay? Liabilities represent a creditor's claim on our assets. Liabilities are simply things that we owe to other parties. Okay, it could be money that we owe, goods and services that we owe. It's usually money that we owe, but liabilities are what we owe to others. And then equity is going to basically be the residual of the two of those. Equity is going to include capital contributed by the owners, and it is going to include an accumulation of the net income and net losses incurred by the organization. So that's the basics of the accounting equation. Again, we'll look at that more closely in future videos. All right, so now let's talk about some assumptions, okay? We're going to make some basic assumptions when we are reporting financial statements. First is the economic entity assumption. The economic entity assumption tells us that a business is accounted for separately from other business entities, and here's where it's really important: it is separate from its owner, okay? So we can't have the commingling of owner funds with business funds, okay? The business is its own entity, and anything reported on the financial statements should be specific to the business entity. All right, the going concern assumption. This means that we are going to presume that the business is going to continue operating indefinitely, okay? Now, you may think, well, what is the opposite of that, okay? Sometimes you will actually hear that a company has a going concern issue. If a company has a going concern issue, it means we're not absolutely sure that that company is going to be able to survive, okay? That company may actually be at risk of going bankrupt, being closed down permanently, or being sold off, okay? The going concern assumption means unless we have evidence, indicating otherwise, we're going to assume that the company is going to continue operating indefinitely and that they're not going bankrupt. All right, the monetary unit assumption. This just means that we're going to assume that we can report everything on the financial statements in dollars. For example, in the United States, that would be U.S. dollars. If you were presenting in other countries, it might be the euro or the British pound, depending on where you're reporting. But for the U.S., we are going to report in U.S. dollars. And lastly, we have the periodicity assumption, and this presumes that the life of a company can be divided into time periods such as months and years, and that useful reports can be prepared for those periods. Now, again, the company's filing with the SEC. If they're a publicly traded corporation, they will be filing quarterly and annual reports with the SEC. But most companies are going to prepare monthly financial statements as well, at least for internal purposes, that is, review by management. Now let's talk about some basic principles that we follow. The historical cost principle, sometimes just referred to as the cost principle, means that normally accounting information is going to be based on historical cost, okay? This becomes especially relevant when we are reporting long-term assets. And the key here is that we are not going to increase the value of our long-term assets just because their fair market value may increase. Okay, so we're going to report everything at cost. When we acquire something, we record it at cost, and that's how we're going to carry it on the financial statements. Now, revenue recognition, and I'm going to go ahead and say revenue and expense recognition. These are really key principles. We are going to recognize revenue when we earn it. We're going to recognize expenses when we incur them because it supports the next principle, which is the matching principle. But let me go ahead and say when we're talking about revenue recognition, you may think, well, what does it mean to earn it? We have earned the revenue when we have provided whatever goods or service we are contracted to supply to our customer. Okay, so when we have delivered the goods or services that we are required to provide, based on the agreement with the customer, that's when we've earned the revenue. Okay, and we record the expense when we have incurred it. Now, that brings us to the matching principle. And the matching principle says that by recording revenue when we earn it and expenses when we incur them, we are able to match expenses against the revenue they help to generate. And in doing so, we are able to achieve the most accurate possible picture of net income. So that's really what the matching principle is about. It's about achieving the most accurate net income that we can possibly achieve on the financial statements. And the full disclosure principle is actually very simple. It just means that if something would make a difference to a reasonably knowledgeable and informed financial statement reader, then we have to disclose it. And as we move along in our studies, you'll learn various things that have to be disclosed, but just know there are lots and lots and lots of things in addition to the financial statements that companies have to disclose. There is an entire section that follows the financial statements called the notes to the financial statements, and it is a very, very lengthy section of the annual report, and lots of things have to be disclosed there. But the basic principle is, if it matters, if it would make a difference to a financial statement reader, then we need to disclose it. Okay, and we have just a few constraints to talk about, okay? Not much to talk about here. The cost-benefit constraint, okay? This one doesn't, it only comes into play in a few areas. I was trying to think of the best way to say that. It's easier to kind of look at how it applies when we encounter those situations. But basically, it really comes into play when we're talking about degrees of accuracy, okay? We have to look at whether the cost of providing a certain degree of accuracy exceeds the benefit of providing that degree of accuracy, okay? So we always want to make sure that the benefit is going to exceed the cost, okay? And again, we'll look at some examples of that as we progress in our studies, where sometimes maybe we're willing to sacrifice just a tiny degree of accuracy because because of the cost-benefit constraint, all right? Materiality constraint simply means, would it make a difference to a financial statement reader? If it would make a difference, then it's material. If it would not make a difference, then it's not material. And again, this becomes easier to see as we start looking at some real-world companies. As an example, if we're looking at a company that reports figures on the financial statements in millions, okay, and there are lots of companies that report in millions, any of the big companies, Walmart, Apple, Microsoft, they all report in millions. So if a number is off by $1,000, you're probably not even going to see that in the it's not even going to appear in the financial statement because it's so much smaller than $1 million. It doesn't even make the number move. So that's kind of an example where, we might think, well, of course $1,000 is material because it's material to us, right? But if we're talking about a big company, it may or may not be material. And so that's something that you kind of have to learn as you go. And then the last one is going to be conservatism in industry practice. Okay, the principle of conservatism basically means that if we are looking at two equally likely alternatives, we always want to take the path that is one, the least likely to overstate assets, and two, the least likely to overstate net income. Okay. And that's what being conservative is really all about. And the principle of conservatism really underlies a lot of areas in accounting, and we'll look at some examples in some later videos. And then industry practice just means, again, we want to, generally speaking, unless we have a reason not to, we want to follow the same practices that other companies in our industry are following. All right. The financial statements. So you've heard me talk a lot about the financial statements so far. What are the financial statements? There are 4 basic financial statements. Okay. There's the income statement. This is where we report our revenues and expenses. Then we have the statement of retained earnings. Now, let me say this one goes by a lot of different names. Sometimes it's called the statement of retained earnings. Sometimes it is called the statement of equity, the statement of stockholders' equity, the statement of shareholders' equity. It goes by lots of names, but regardless of the name it goes by, it's going to do the same thing. It's going to show us how our equity has changed from one accounting period to the next. Okay. And then we have the balance sheet. The balance sheet is the financial statement where we prove that our accounting equation is true. The balance sheet is going to detail the components of our assets, liabilities, and equity. And then last but not least, we have the statement of cash flows, and this is where we are going to detail our cash inflows and cash outflows over a given period of time based on very specific categories. We will categorize them into operating activities, investing activities, and financing activities. And having that breakdown puts our financial statement users in a better position to understand how we are generating and using our cash. So this brings us to the end of our introduction to financial accounting video. I hope that this information is helpful, and I will look forward to seeing you on our next video.